All right, let's go ahead and get started, and people can trickle in if they're running a little bit late. Just as a reminder, this is being recorded, so folks that registered but do not attend are going to get a link to check out the video. Um, thanks for coming. Thanks for being with us. We hope that this is beneficial for you. You IPO'd, now what? Like, that's the big question. And we hope that the information we share today, the frameworks that we give you today help you make good decisions with your Reddit stock that is now publicly trading. So just by way of introduction, here's who's on the call. We've got Chris and Brett, who are both financial planners and advisors here at SecFi, and myself. I'm John Morrison. I'm the head of portfolio management. Chris and Brett have been advising people with equity compensation for a long time. That's their specialty within the financial advice world. And I've been a portfolio manager, managed mutual funds and ETFs and institutional accounts for several years. So we've got some expertise on the call, and that's who we'll be presenting to you today. A few disclaimers. This is educational. This shouldn't be taken as advice for your specific situation. In order to get advice for your specific situation, and that's something that's going to come up throughout this discussion, you should talk to someone who knows you and knows how this stuff works. And hopefully this is educational and helps you think through it. But again, it's not specific to you, and you do need to talk to someone to really understand what's the best choice for you. All right. What does SecFi do? We've got different offerings. We have some DIY tools on our site that help you evaluate tax implications of option exercises and things like that. It's mostly geared towards private companies, so prior to IPO. So it may not be as relevant for you folks now, but if you join another startup, it could be very relevant. We also do financial advisory and wealth management, primarily for folks with equity compensation. That's the team that Brett, Chris, and I are on. And we do financing of option exercises and secondary market transactions and private company shares. So different ways SecFi works with folks. Today, you're talking to the advisory and wealth management team. So let's get started. First of all, congrats. Getting to an IPO is very rare, and your company did it, and you were a part of that, and you should feel very proud. So on the right-hand side is a graphic I took from CB Insights that has done this study about how many companies have successful exits and IPOs. It isn't many. It's single-digit percentages of companies that are funded by VCs that actually end up IPOing. More exit, but an IPO is the rarest of the exits. So you should be very proud, and this is a rare thing that you've been able to go through in your life, and let's try to make the most of it. So what's the timeline? Well, your company's already gone public. You've listed, obviously. Your lockup expiration is kind of the next big event for you all, and that's going to happen after Q2 earnings are released. The document says 3 trading days post Q2 24 earnings is when the lockup will expire, and insiders will be allowed to sell their shares on the exchange. So Q2 ends in June. Usually there's about a month or so from the end of the quarter until you actually announce those earnings. So look for that lockup expiration to be sometime at the end of July, beginning of August, give or take. Pay attention to whatever Reddit is telling you. Of course, they're going to have the details. So the big question is, should you sell, and how much should you sell, and which shares should you sell if that is indeed the right choice? And the big answer to that is it depends. So again, kind of on that theme of this isn't specific to you. A lot of variables can come into deciding whether or not, or how much, or which shares to sell for anyone who's gone through an IPO event. Things that might matter are your balance sheet, your concentration risk. So if Reddit makes up, 80, 90% of your net worth, I can pretty much guarantee that the right answer is sell some of it, because that's a very high concentration risk. If your balance sheet is very robust, in other words, you have a lot of money already, maybe you don't need to sell as much Reddit equity in order to secure your financial future. So it kind of depends on what your balance sheet looks like and what your concentration risk looks like. Also, risk tolerance. What goals do you have? What plans do you have? What's your asset allocation? In other words, what other investments do you have? Are they complementary to the exposure that you have to Reddit, or or does your asset allocation, your other investments, kind of double up on the same themes and risks that Reddit is exposed to? All those things will play a role. And then, of course, everyone's favorite topic is taxes. Uh, what's your tax rate? What are the tax implications of selling particular shares? Different equity has different taxation. So we'll talk a little bit about that in the coming slides. But all of these things can impact whether or not it makes sense for you to sell, and how much to sell, and when to sell, and which shares to sell. On the right-hand side is a sort of a guiding quote that I like to think about whenever I'm helping someone decide whether or not and how much to sell. Don't risk what you have and need for what you don't have and don't need. I can't tell you how many people we've talked to who had secured the bag and then fumbled it, to use the the slang, because they, frankly got greedy and wanted to hang on for higher returns from their concentrated stock position. You know, it's not that that is wrong to hang on and to anticipate some upside and to participate in that upside potentially, but you got to take that risk with eyes wide open of what the possibilities are and what the implications are if things don't go the way you think they might go. So I always like to start with that quote from the esteemed Warren Buffett.
One thing I'll chime in real quick, John, is,
Yeah.
having, with some of our clients, recent IPOs at companies like Instacart and Klaviyo, there's clients that, went public at other companies before that, is I think, during this lockup period, now is really a good time to be thinking through this. I know that it can be a really emotional time when you are unable to sell and you have to watch. And over the past couple of weeks, Reddit stock price has bounced up and down quite a bit. But I think really just, honing in on, what is important to you and to your family, what could this money mean? And obviously, there's still going to be, a little bit of time before you can actually take action. But I think when that lockup period does happen, that is going to be an even more emotional time. And I think one thing that we have seen time and time again is, if you haven't thought of a plan and like you're going into the lockup and selling stock, and having emotions are going to be playing a big part of it, I think it can lead to some suboptimal outcomes. And so I think having thought through, okay, what are my upcoming cash needs? What, could this help me secure? And then how does that then influence how I think about selling? Which grants and which shares do I sell down and prioritize? So anyways, I know that the action cannot be taken yet, but I think this can be a really good time to just think through more of what are those things that are important, and that will influence, and then we can just be very adaptable as the price moves and your situation changes over time.
Yep, exactly, Chris. Okay, so IPOs, they typically have a pop on that first day, and Reddit fit this description. I think you guys traded up into the 60s on that first or second day of trading. Now you're back down to about $40 a share, but still substantially above the initial public offering price. And that is not uncommon. Most IPOs, or the average experience of an IPO stock, is that it goes up on that first day. However, that experience varies widely. And once that pop has occurred, there's a very broad range of outcomes for single stocks. And newly IPO'd companies tend to be even more volatile than your typical individual stock. So just to kind of drive home the point of why you may want to consider reducing some concentration depending on your personal circumstances, I put this little graphic together to show you, what actually happened to individual stocks in the US market last year. So last year, the Russell 3000, one of the broadest, measurements of the US stock market, 3,000 companies, it had a pretty solid year. It was up almost 30%. But the market return is not the experience of any individual stock. And you can see a very wide variance between the worst performing stocks and best performing stocks. Some stocks went to zero last year, even though the market was up a lot. Some stocks had several hundred percentage point returns. And this is not a uncommon, spread in terms of what stocks do in any particular year. Any stock can be very volatile. And even in a year where the market was solidly positive, more than a third of companies actually went down. So you never know what any individual stock will do, but it's important to understand how wide the variance of outcomes can be, and to incorporate that into your decision about whether or not you should sell and how much you should sell. Okay, so let's get into taxes, because the tax implications of exercising options and or selling the shares that you have can really, add complexity to what your decision is. So we've got three types of equity here on the page: incentive stock options in green, NSOs or non-qualified stock options in blue, and RSUs in gray. And we have three different events: when they vest, when you exercise, and when you sell. And at each of these points, there may be a tax associated. So with ISOs, if you're sitting on ISOs or you have exercised ISOs in the past and now hold shares, you will be the type of tax that will apply to your situation is capital gains. If you've held the shares for more than a year since you've exercised and more than 2 years since they were granted to you, those capital gains on those formerly ISOs, now Reddit shares, will be taxed at capital gains rates, which is preferable to other rates of tax, which you'll see on an upcoming slide. If you have not exercised and need to exercise before you can sell, then you might be subject to AMT, so the alternative minimum tax, and you may have heard some horror stories about AMT in the past. So two potential taxable events with ISOs: upon exercise and upon sale. NSOs are the same, taxable events, but different tax rates and different tax treatment. So it's a similar idea. You might get taxed upon exercise, and you will get taxed upon selling. And the type of tax that applies upon sale is capital gains. The type of tax that applies on the exercise is ordinary income tax. Then with RSUs, when your company was private, you had no tax upon the vesting event. But once it did go private or public, that vested all the shares that were, previously time vested. And that is considered income at the time of vesting. So upon meeting both the time vesting schedule and the liquidity trigger of an IPO, that gets taxed as income tax. And then any appreciation above that point gets taxed as capital gains, and whether short-term or long-term depends on your holding period. So somewhat complex. And if you've got a mix of different types of equity, you should really understand what the implications are for selling or exercising any of those types of equity, because it could lead to a prioritization schedule of which shares you would prefer to sell first, because they may have the lowest tax impact on you. So that's why we, put this in here. It is a little bit complex, but there are a lot of moving parts. And this is why, I say, think about it and make a plan. Chris, would you want to add anything to what I mentioned here on the taxable events page?
Yeah, so I think one thing that is a theme I see is this can be pretty intimidating and daunting. All these different types of tax, and I think one thing that I always like to tell folks is it is not an all or nothing decision. It is not an all or nothing when it comes to exercising your options. It's not all or nothing when it comes to selling any shares. I think really understanding what makes sense for you. So for exercising, if you are sitting on vested but unexercised options, could make sense to exercise some. I think one thing to consider is now that Reddit is publicly traded, you really got to be optimistic on the price going forward, because as John mentioned, to get that preferable long-term capital gains treatment, you're gonna have to hold those shares for at least a year beyond the exercise date. And then depending upon the type of options that they are originally, with ISOs, you got a little more of a kind of a leeway and some grace period. With NSOs, it's really going to be that upside from today's price or whenever you exercise, that is going to be that upside potential, which would be taxed at a lower rate. But the other thing I'll note is, if you had some RSUs that vested, it is likely that, with that new income, that this is going to be a, abnormally high income year for you. And there's a lot of planning opportunities that come with that. And the other thing is, because the lockup period will be happening after the Q2 earnings, that means that you could sell some shares in addition to having vested some RSUs. And so you could be able to get some liquidity before your 2024 tax return is, due and filed. But I think determining, okay, if this is a higher income year, maybe I don't want to unload all of my shares because this is already a higher income year and I might be in a higher bracket. So what are some things I can do to lower or claim some additional deductions and defer that income into future years? And so those are all types of things that when we're thinking through a sales strategy and we're doing some tax planning with folks, is we're going to take into account, first of all, what are your priorities and kind of securing the bag, but then, being able to get a little more tactical from a tax front, because at the end of the day, it's not about, what the dollar on paper is, it's what you keep. And that's ultimately what allows you to build wealth over time. And taxes, they're not the only factor, but they are a significant factor in helping you to grow your wealth and build that compound, is ultimately what you are going to net as a result of some of these actions.
Awesome. Thank you, Chris. So, we alluded to this, but not all taxes are the same. There's lots of different types of taxes and lots of different rates. So, when we're talking about income tax, the federal range goes from 10 to 37%. If you're in California, it goes from 8 to 13.3% on top of the federal tax. New York also has high tax rates. I know there's a lot of Reddit folks in New York. This is specific to California. If you're in any other state, it might be different. So you got to pay attention to what both of those rates are, and the ranges, and make the right decision. AMT, or alternative minimum tax, has two rates of 26 and 28%. The cool thing about AMT, and you'll see that on the next slide, is you can get it back as a credit in the future. So think of AMT somewhat as a prepayment of future taxes owed potentially. So that's AMT. And then short-term and long-term capital gains. The key one you want is long-term, because the rates are much lower. I mean, look at that spread. It's 0 to 20%, depending on where your income shakes out for the year, which is much better than 10 to 37%. So if you can save, if you're at the high end, 17% of your gains, that can be quite meaningful, from a net on paper, how much you take home perspective. So as you think about deciding what to do with your equity, consider what type of tax is assessed on that equity and what your holding period is, and therefore, what rate might be applied to your gains. All right. How do you get your AMT back? I'm going to defer to Brett on this one. Brett, do you want to walk through the AMT dance here?
Yes. So this is a great slide showing an extremely simplified version of how you'd get your AMT back. So understand that this is a very high level example, but there's a lot that goes into the alternative minimum tax. So before we look at this slide here, let's understand that when you file your taxes, there are two tax equations running. Okay. Some people never have heard of the alternative minimum tax, but you pay the higher of your two taxes. So you have the regular tax and you have your AMT tax. Most folks are paying regular tax because they're not increasing AMT. Okay. One of the key drivers that increases their alternative minimum tax would be an ISO exercise. Okay. So that fair market value minus your strike price is going to be, we'll just call it spread. It's called bargain element, but spread's a lot easier to think through. That spread is not ordinary income taxable. It is alternative minimum taxable. Okay. So as you increase the alternative minimum tax side of your tax equation, sooner or later, you will jump over your taxable income and you will bump yourself into what's called the alternative minimum tax. So what we're showing here on this slide is a very simplified version, but let's take an example of a situation in a year where you do exercise some incentive stock options. Your regular tax was $50,000. Okay. You exercised incentive stock options, you pushed through that regular tax threshold, and you started paying into the AMT, okay, to a total of $70,000. What that essentially means is that you are going to pay $20,000 on top of the $50,000 standard tax. Okay. It will be, your tax will be assessed at 26 or 28%, as we saw on the prior slide, because that is the tax the alternative minimum tax is assessed at. You might instantly be thinking, hey, that's a lot lower than if I'm in the 37% federal marginal tax bracket. The key to know is that for the alternative minimum tax equation, a lot of things that are not added into your taxable income get added into the alternative minimum tax equation. So while your marginal rate may be lower on the AMT side of the equation, you may end up paying more in total tax, and you most likely will end up paying more in total tax because of it. But back to the example. So what happens is, because you've paid that $20,000 over the standard tax, you are given a credit by the IRS. Okay. Now that credit will be returned to you, okay, in any year in which your regular taxable income is then higher than your alternative minimum taxable income. Okay. For most folks, that is going to be pretty much any year that they don't exercise incentive stock options. Okay. There's a lot of other factors that go into it, but for the crowd that we serve, it tends to just be years you don't exercise incentive stock options. So what happens is in this example, let's say 2025, you exercise no incentive stock options. Your regular tax is again 50,000. And now, as a normal year for you, your alternative minimum tax would be 40. You would get 10,000 of that $20,000 credit back. Okay. What's important to note about the alternative minimum tax is that you don't take it with you when you die. Okay. So it is a interest-free loan to the IRS. Okay. And they are not giving it to your family members if you don't recoup it. Okay. So you do want to be cognizant of the fact that when you implement a strategy around your incentive stock options, you want to think through how you're going to sell them, because one of the key drivers to getting credit back is selling the incentive stock option shares that actually created the alternative minimum tax in the first place. It's a very complicated equation of how that works, but just know that that is one of the big drivers to get the credit back, would be selling what created the AMT. So when we implement plans for clients, what we are showing is we are building tax projections alongside CPAs. We always have CPAs double check these things, but what we want to show is, how do you recoup that credit, right? So if you do pay AMT, we just want to have a plan for how the recouping of credit is going to happen down the road as well.
Mm-hmm. Awesome. Thank you, Brett. Yeah, the get your AMT back. You don't want to be double taxed. Like, find a CPA, work with a financial planner and tax planner, because this is meaningful money. You don't want to give it up.
Well,
So,
one thing to notate, John, is if
yeah.
you have exercised incentive stock options in the past, and you maybe were just using TurboTax or something like that, and you've never looked if you possibly paid AMT, maybe there was an issue or something in the software, just double check. It is something that we find very commonly, is that maybe you did pay AMT, you didn't realize it. What happens is it is incumbent upon you to track the credit. So nobody will really do that for you. You have to do that on a form 8801. So if you have paid it in the past, we do see it in years where people just forgot they had credits. So we want to make sure you get that back.
Yep. Exactly. All right. So getting back into, should you sell your stock? Everything is trade-offs in this life. Every decision is multi-factor, as I like to say. The analogy I like to use is, you don't choose which restaurant to go to based on one characteristic. You don't just sort them on price and then go to the cheapest one. The price, of course, matters. The type of food matters. The distance from your house matters. What you're in the mood for matters. There's all sorts of things that go into the decision. Where am I going to go out to dinner? The same is true with, should I sell my options or should I sell my stock? And the important thing is that you actually know what the trade-offs are, so you can make an informed decision. So this is one piece of analysis that might go into that. What I'm showing here in the graphic is the break-even share price that makes a holder of Reddit stock indifferent to selling now and getting short-term capital gain treatment or selling later for long-term capital gain treatment. So the blue line at 40 represents Reddit's stock price today. The red dotted line represents the break-even price, or the price at which Reddit stock would need to be once you reach long-term capital gains to make it equivalent to selling at 40 today. So it's going to differ depending on what your cost basis in the shares are. And what you have to ask yourself is, is it worth the risk to hold on to this thing for as long as it takes me to get to long-term capital gains to save, XYZ X dollars? So just to bring it home, in this particular example, the person has some shares with a cost basis of $28. That's that gray bar. Looks like they've got a little bit more than 8,000 shares at 28. And what that implies is, well, they could sell today at 40, or they could hold to about 36, 37, or they could hold for long-term capital gains. And if the shares are above 36 or 37 bucks roughly, then they're happy they held because they're better off. And if the shares are below that number by the time they get to long-term capital gains, then, they would have been better off selling at 40. So this is a sort of what do you have to believe framework to help you make a decision about whether or not it makes sense to hang on and try to get to long-term capital gains or not. And you might make a different decision depending on what your cost basis is, because these shares down here at 8, they've got a much larger, spread between the break-even price. So, we'll say that those shares have a much larger margin of safety to hold to try to get to long-term capital gains than the ones at 28. So an example of the types of analysis that should be done in order to make an informed decision about whether or not you should sell, how much to sell, and which shares to sell.
Mhm. And on this topic, John, I think this also applies to if you have multiple option grants, especially incentive stock option grants at various strike prices. Some of your lower strike price grants are going to be the prime candidates to potentially be aggressive and exercising and holding, whereas some of those higher strike price grants, again, there's a lot less margin of safety. So anyways, it's something that not only are we going to factor this in on a sales strategy, but on an exercise, because you could exercise even though you're not able to sell during the lockup period. And so staggering, exercise and sale events, at different times throughout the year or even across multiple tax years can sometimes, be a winning, proposition for folks, just because it's going to, again, help, hopefully net more to them. And it also can help from an emotional perspective. We don't know what the price is going to be in the future. And so if you want to be able to have some exposure to Reddit shares, if it does rebound and get back up to that $60 price range, by being able to kind of stagger, some of those exercise and sale decisions, but prioritizing some of the earliest ISO grants with the low strike price can make sense for some folks.
Exactly. Thanks, Chris. All right, let's get into how to sell. So I think this is an overlooked part of the decision process and the actual execution of your plan. And I put this little graphic in here. And the takeaway is when you trade stock, you want to blend in. You do not want to look like a tourist. The left-hand side, obviously, are tourists. The right-hand side, bunch of New Yorkers walking, down the street. You can't really, everyone looks like a New Yorker on the right-hand picture. The people on the left obviously are tourists. And when you trade stock and you're a tourist, you're going to get mugged. Because the professionals that are trading can tell that you don't know what you're doing, that you're new here. And so I want to give you a little bit of insight into what you can do to protect yourself from getting mugged, symbolically, and give you a little bit of insight into how to blend in with the market as you execute your trading plan to sell shares. And not to scare you too much, but this is a stock chart of a Klaviyo, which went public last year. And this occurred, I saw this happen in real time because we were executing on a trading plan for one of our clients. And I was trading Klaviyo shares over a period of time for that client to get down to where they had desired to be from an exposure standpoint. And as I was doing so, I was, monitoring the price and the volume and the liquidity in the shares. And I saw this big red candle down, where it looks like someone got mugged. So what this represents is a trade that happened that executed at $24 and, between 50 and 75 cents. So we'll call it 24.60. Whereas the trade right prior to it was at around 25.80, 25.90, close to 26. So whoever did this trade lost $1.50, $2 a share, roughly. And they did it on 50,000 shares. That's what this bar down here represents, the volume that was traded at that level. So this potential person who, had they blended in and not traded like a tourist, they lost over 50 grand on this single trade, because they could have sold it over time for a much higher price, but instead they unloaded it all at once and it dropped the price significantly. That's a tourist getting mugged. Don't do that. So how do you not do that? Well, there's a lot of things that go into it, but I want to give you the biggest, most important thing. When you sell your shares, use a limit order. So there are different order types when you go to sell a stock. One is called a market order. One is called a limit order. And a market order, what you are communicating when you submit a market order is sell all these shares immediately at the best available price. And if you have a lot of them, 50,000 in this example here, and you do it in a market order, there might not be enough demand within that split second of time to meet your supply at a reasonable price. And you might get a trade executed for a poor price. So in order to prevent that, you can submit a limit order, which specifies a price at which you're willing to sell shares. So it will only execute if the price of the stock goes above that number, and then it'll sell. So that is probably the most important thing you can do to protect yourself. If there's other considerations too, but this is probably the biggest one. So if you haven't submitted a limit order in the past, figure out how to do it on your brokerage platform, or talk to someone who does know how, and potentially hire them to do it for you, because losing 50 grand in a single trade, it's not a fun day. Okay. Next slide is putting together a sales plan. So, Chris mentioned this earlier in the presentation. Um, this is a high level example of a sales plan. And what I want to drive home is that, you know, it's not it's not as important to have um, it's not as important what the plan actually is. It's more important that you have one and that you stick to it. And whatever plan you make should be driven by your goals. Align it to your goals. Uh, it'll help you remember and stick to the plan if it's associated with something that you're trying to achieve in your life. So in this particular situation, the person's priorities are they need $250,000 for a down payment on a house. They want to fund an emergency savings account with 50,000, and they have some other smaller dollar item numbers that they want to fund, and they would like to set aside at least 250,000 for longer term investing. So those are their money requirements that results in them needing to generate proceeds net of taxes of what is that 585 thousand or 500 yeah $85,000. Wait,
95.
95. Yeah. $595,000. And so what this person did and what we helped them think through is how much they would sell at different price points. So if the share price was less than 30, they would sell 50% of their stock. And as the price goes up, they wanted to sell more. If it went down, they wanted to take the risk and hold in hopes that it would rebound. On the other columns are the results. If they sell 90% of their stock at 45, they're going to walk away with over $1 million net of tax, and they'll have 690,000 to invest for the long term, in addition to satisfying all these other goals. So the main thing is that you make a plan that it's aligned with your goals, and then you stick to it. Once that stock starts trading, as I'm sure you are all aware, it is hard not to look at it and get stressed out by its volatility. That's why making a plan ahead of time and aligning it with your goals can really help you stick to the plan and results in better success rates for people actually achieving what they want to achieve. Any
One
thoughts on
simple
sales plans? Yeah.
Yeah, I would say just like one simple framework, it's kind of taking a step, back and zooming out from this is, I think a good way to gauge of, whether or not you have too much exposure to any one stock, whether that is Reddit stock or whether that is Apple stock, is, if you find yourself pulling up, your stocks app on your iPhone, multiple times and like looking at that, and especially on some days as we've seen of late, where there's been some pretty big swings, 5, 6, 8, 10% in a single trading session, if that, causes just a visceral, like in some, panic, that probably is too much exposure. I mean, at the end of the day, like kind of our belief is that money, is a tool, and money can be used to help facilitate, some wonderful things. And it's not meant to be. It can cause some stress and anxiety, but it doesn't have to. And so, right now with the Reddit stock specifically, you're locked up. So you're going to, somewhat have to kind of endure that. But, once that the Q2 earnings come out, like you no longer have to be going through that. And so I think just to kind of set some, frameworks is if you find yourself checking the stock price, on multiple times, and there's a big kind of spike in, if seen a day, where it's up 5-10%, but there's a big like, weighted like feeling on the days that it's down, it's probably too much. So again, the right percentage of holding is different per individual. I think as a general rule of thumb, we like to see that lower than 20% for folks. I think that's a prudent from a diversification and a risk management perspective. That's not blanket across the board, but I think just something for folks to be thinking about is, if there is, if you find yourself checking the stock price multiple times a day, you're probably holding too much exposure to that stock.
Yeah, great point, Chris. There's actually a lot of research on this topic, academic research about, risk aversion and the the rule of thumb from the empirical research from psychologists and economists is gains are less positive feeling than losses are negative feeling. In fact, they've even quantified it, and it's roughly, losses feel about 2 times worse than gains feel good. So if you go up 5%, and you feel, that elation, when you fall 5%, it's going to be twice the strength of the emotion, but in the opposite direction, typically. So, all right. Now we get into what should you do with the proceeds. You know, everyone's different. We keep saying that. So we can't tell you, but what we can tell you is that you should think about why. Because you want to live your best life today and in the future. You want to be a good steward over your money. You don't want to be constantly feeling that pit in your stomach of anxiety of where's the stock going to go, what's going to happen after earnings. So when you determine your why, it creates discipline and it improves your decision quality because you don't have to make so many, because you've already decided, why you're going to do the thing that you're going to do, and that sets you to do it. I think this is really important. So as you're approaching this expiration of the lockup window, think about why you need the money or what you want to do with it. And that's going to help you make better decisions for all these reasons that we see here. Brett, do you have anything to add on this page?
Yeah, I was just going to add in that when we even take a step back out just from what happens surrounding the equity, right? When we take a look at our why and we see the potential results that can happen, right? For many folks, it's a life-changing windfall. For some of us, it may not be life-changing, but it's still very important dollars. Being a good steward of your money goes further than just, beginning to make a diversified portfolio. Right now, during this lockup period, a lot of things can get done in the anticipation of this future windfall. So some of the things to think about: do you have an estate plan in place, right? This new wealth is going to create a need for protecting the assets and for shifting them, if you're no longer here, to the right people, right? There could be significant money movement happening. It's looking at beneficiary designations on your accounts. Okay. If you've already done estate planning, make sure your beneficiaries on like your stock accounts and your brokerage accounts, that they're going to the people that you intend for them to go to. I would take it even a little bit further, start thinking about looking at insurance. So one thing that we do see for a lot of folks is umbrella insurance. If you've never heard of it, think of it as kind of an umbrella that would sit on top of any type of like property and casualty you have. At a high level, it protects your net worth. Okay. So if you were to be sued, it's going to protect your net worth. If you are looking at a very strong increase in your net worth, you should consider looking at umbrella policies. They're relatively cheap, a couple $100 a month usually, or a year. And it can go a long way in protecting yourself. So, I would just say there are blind spots that can come up. And as John said, limiting the amount of decisions you're going to have to make when emotions are running higher as you're trading is essential for folks. So I would just say, start thinking through some of those things as you proceed through this lockup period.
Really good point, Brett. All right. Now, Chris kind of alluded to this at the beginning of the presentation, but and this sort of fits in line with that stewardship of your wealth topic, but it's likely if you sell some of these shares, or even if you don't, because your RSUs vested when Reddit went public, you're likely in a very high income year relative to what you're probably going to earn next year and what you've earned in the past. And that's going to put you in a different tax bracket, potentially. And that might lead to a bunch of opportunities for planning in order to, make you better off from a net wealth standpoint down the line. I'd love to bring Chris in here to kind of talk a little bit more about some of these potential opportunities or highlight others. Chris, do you want to pick a couple and tell the folks what those are?
Yeah, of course. I think, to provide a framework to set the stage before talking about some of these specific, when we're thinking of a tax strategy for clients and people that we're working with, we zoom out and we view taxes as a lifetime game. This, yes, may be a high income year, but I think, for us, a winning proposition is not, how can I pay the least amount of tax in 2024? It's how can I pay the least amount of tax, in a fully legal, adhering to, the IRS, rules over the course of my lifetime. So that's, being able to, defer income, accelerate deductions, do some of these more, tactical strategies in the high income years, but it's also taking advantage of low income years. So maybe this is, a gap in between, jobs. Maybe this windfall could allow you to take some time off of work so that you're not reliant upon, an employer, W-2, but you could travel, you can spend some time when your kids are young. You could maybe pursue, a business venture of your own. So anyways, if any of those things are things you want to accomplish, like, know, first of all, that could be attainable. And that's part of the thing that we can help to plan for. But in, specifically in a high income year, one thing I mentioned was to accelerate deductions. So for any folks that are charitably inclined, there's, local organizations that you want to support, this could be a really good year to clump multiple or pre-fund, a couple years worth of, your historical donations into a vehicle that's called a donor advised fund. So what this does is it allows you to get a bigger tax benefit in a high income year on your 2024 tax return, but you have the discretion to be able to distribute or disperse those funds to charities over a multiple year period. So if you say, what, I've historically given $5,000 to my church, and then, another $3,000 to the local, animal shelter, and I want to continue that, but I want to be able to take advantage of this higher income year, you could fund, maybe call it $15,000 or $20,000 worth of donations. And you can even do this with highly appreciated stock, not just cash, into this donor advised fund vehicle. And then, it's this charitable bucket. So it is important to know, it is designated for charity, it is a irrevocable donation, but you set the terms of how, it is dispersed into which organizations. So that's one technique. And then another thing I'll just call out is, this can be this anomaly or kind of outlier year. And so if this is a year that is, it's standing out, and this is the first time you've had, a over 500,000 or maybe even over $1 million, income year, then there's certain things that we could look at that maybe contributing to your employer's Roth 401k has been a great, opportunity for you since you're in the early stages of your career. But maybe it makes sense to switch that up now, even before you've sold the stock, because if I'm selling stock, I'm going to be in a higher tax bracket this year. And so maybe I want to switch Roth 401k contributions into pre-tax, lower my income, and receive a bigger deduction. So anyways, those are just a couple of the things that we're looking at. And then depending upon the size of the windfall you're going to be receiving, and ultimately, again, what your objectives are, it's really kind of coming up with a plan to use these dollars and use this wealth to help you live the lifestyle you want, being mindful of taxes, and also kind of looking out for what's to come in the future.
Yeah, John, can I add one thing here?
Yeah, please.
One major opportunity. Chris mentioned the charitable donations. If you are charitably inclined, that is a huge opportunity in high income years, especially years of, going IPO and maybe RSUs vesting, those kind of things. I would also just add portfolio management here is huge. One of the things that you can do is tax loss harvesting. And I won't speak for John, but what I would say is having somebody who's aware of your situation to accelerate losses can be beneficial to your tax situation in years where you're going to have very high income. So maybe it's like the RSUs vesting, those kind of things. You can take some of up to $3,000 of loss on your tax return each year, and you can carry forward those losses. Where it really will even accelerate its benefit is if you do hold incentive stock options and you end up holding them for long-term gains, you can net gains and losses against each other. So having somebody who understands your portfolio, who is aware of your situation, that you are going to be bringing in a lot of gain income through like incentive stock options, can really accelerate losses and help bring down that tax liability for taking in those proceeds. So just something I would add there. We see it very commonly. It's nothing against robo advisors or anything like that. It's just, they don't know your situation from a tax perspective. So they, can't be a lot more aggressive in those kind of things. So I just wanted to drop that in there.
Yeah, it's a really good point. And just know that there are, how you invest matters for being able to do tax loss harvesting. So, talk to somebody, but it could be an opportunity in a year where you have a windfall like this to lower the impact of that windfall from a tax perspective. All right. We're near the end here. If you've learned something or you're feeling regrets about not taking action in the past, don't feel those regrets. Focus on how to make it better going forward. We can't change the past. We can only think about the future. And hopefully the things you learned today do help you do that. I encourage everyone to sign up at secfi.com to use tools, read some of our educational material, or you're also very welcome to book a call with one of us. We'd love to talk to you about your situation and see if there might be a good fit to work together. Our calls are really no pressure; they're free, and we're not salespeople; we're advisors. So please go ahead and book a call with us. We'd love to talk to you about your situation. And with that, I would like to open it up to any further questions. I do think we've answered all the ones that I've seen come in through the presentation. But if anyone has anything further, please submit it now or forever hold your peace. Or you can just follow up with us via email. Okay, I'm not seeing anything more come in, so I'm going to go ahead and call it there. And thank you all again for your attendance, and we hope it was beneficial. Best of luck to you all, and we're rooting for Reddit, and we hope Q2 2024 earnings are stellar, so you get a nice pop when your window opens to potentially sell. Have a great rest of your day, and we hope to see you soon.